And here is your closing bell on Wall Street.
And that's your closing bell for this Tuesday, March 15th. The major averages close positive across the board. Let's take a look at the Dow, the S&P, and the NASDAQ. The Dow closes up 600 points on the day, just about 1.8% higher there. We also saw a move higher for the S&P 500 to the tune of more than 2%, 2.15% to be exact, 89 points to the upside, and also closing in the green. Yesterday it took an L, but today, slight bounce back. It's up 2.9%. That's where it ends the day for the tech-heavy NASDAQ. 367 points in positive territory. Brad Smith, along with Rochelle Akufo and Dave Briggs, plus our closing bell panel that we've got to help us break down today's tape. Michael Kushma, who is the CIO of Broad Markets Fixed Income at Morgan Stanley Investment Management. Plus, we've also got Jack Ablin, who is the Cresset Capital Chief Investment Officer. Thank you both for taking the time here with us today. Let's just get right into it. And I want to start with you, Michael. We've now kind of gotten all of the fodder out of the week so far. Now we're squarely going to get into the Fed. It's widely telegraphed, 25 basis points, but the dot plot, what are you looking for there?
Well, the dot plot should increase, given all the news we've had between December and today in terms of inflation's turned out to be higher than expected, the unemployment rate lower than expected. So we have a strong labor market, higher than expected inflation. Oil prices, energy prices, commodity prices are much higher now than they were back then. So all would suggest the Fed needs to get going and that they need to up the dot plot. So I think they'll talk about the mean maybe 5 rate hikes in 2022 and a couple more in 2023.
And Jack, as we know, the Fed criticized for being too slow to react to inflation when it did start to creep up. And then, of course, you have these unexpected events. You have the Russia-Ukraine fallout. Talk about how that perhaps exacerbating that could then potentially shape how the Fed moves forward, depending on how much it affects inflation.
That's it. It's all about energy. And is energy inflationary or is it going to restrain growth? And it looks like it's going to do a little bit of both. Before the invasion started, the bond market expected 7 rate hikes this year. That dropped to 4 rate hikes as Russia invaded Ukraine. Now we're back to 7 again. The one thing I did notice is that if you look at the forward rates on the forward rates on inflation, the market had expected roughly a 3.5% 1-year inflation rate by the beginning of 2023. That now is up to nearly 6%, well over 5% for January 2023. So you can see that investors believe that inflation is going to be hanging around for a little bit longer. Meanwhile, with a curve flattening, perhaps they're suggesting slowing growth. That's not a great combination for the Fed that will ultimately have to decide between fighting inflation and saving earnings.
And Michael, touching on what Jack said there with inflation, do you think things will get worse before they get better? And do we caution against just speculation that the Fed raising rates will automatically kill inflation?
I don't think there's a short-term link between inflation and interest rates. I mean, the Fed is starting from a very, very accommodative starting point of 0 rates. The first 100 basis points or so are not meaningful in terms of slowing things down. It's sort of automatic. It needs to get back closer to normal, whatever normal is, but 0 is not normal. It's an emergency level of interest rates. So the first 100 basis points I don't think will make a big dent on things. The question is what happens after that. So I think they get going, start hiking rates on a regular basis between now and the fall, and then they start playing it by ear and seeing how much of the inflationary process is contractionary in terms of slowing the economy down versus how much is getting entrenched in inflation expectations, which is the real problematic scenario if that does happen.
Much of the data that the Fed is going to be evaluating, some of the lagging indicators, quite frankly, whereas the market's placing their bets on what the future will hold. And when we think about that, Jack, how far out do you believe the markets are looking right now?
You know, just because of the uncertainty, I think the markets are looking out a year because what we're seeing is very high inflation expectations for shorter term inflation and longer term 5- and 10-year inflation rates really sort of hanging around, back in the twos. So I think longer term, the investment community believes that this is a blip that will likely last a year or two. But for the next 12 to 18 months, it's going to be a pretty difficult situation for the Fed as they try to find the right balance between growth and inflation.
And Michael, given the volatility that we've seen over the last 2 weeks with oil prices spiking, now below $100 a barrel, a lot of people wondering, do I buy the dip? How do I position my portfolio? What advice do you have for retail investors really trying to make sense of all of this?
Well, first thing is to sit tight and don't make any precipitous decisions based upon the volatility in one day. So I've had days like early last week and a week ago when oil prices were soaring to well over $100 a barrel, looked like the world was coming to an end. Don't panic in that type of situation and sell into that kind of weakness. Similarly, when things are looking really good, as was discussed earlier on the program, we've had these dead cat bounces lately of very strong amounts, yet we're still in a sort of downward trend movement in the equity market, and certainly bond yields still look like they want to press higher. So I would say just stick to a relatively conservative strategy right now. If you want to buy on dips, don't buy into strength. And if you want to sell strength. Don't sell into weakness, because the story right now is still very, very uncertain. The Fed will reveal something tomorrow. We'll see how much they reveal. And secondly, the whole Ukraine-Russian situation will take time to unfold in terms of its longer-term impact on commodity prices and oil in particular. So don't make any precipitous decisions. There's plenty of time if this thing turns out to be more protracted one way or the other to make a decision.
And Jack, results of a Fed survey out today show the probability of a recession in the U.S. at 33%. That's up 10 percentage points from just a month ago, and it's at 50% in the EU. How pessimistic or optimistic are you that we are coming to a recession this year in the next 12 months?
Yeah, I think that, if you'd asked me 6 weeks ago, I'd say, don't worry about it. Over, the intermediate period, what we saw was credit conditions tighten. That sort of set off some alarm bells here at Cresset. When lenders are less willing to extend credit to incrementally lower quality borrowers, they must see something perhaps that we didn't see. That combined with certainly unprecedented, hikes in energy in Europe in particular, but also here at home, and that's generally a tax that will weigh on growth. So I do think that the odds of a recession are higher. If we got the relationship between the 2-year, which is at 1.8, and the 10-year, at 2+. If that were to invert, that would tip the scales for recession in my book, because every recession we've had over the last 6 or 7 recessions was precipitated, or at least preceded by an inversion of the yield curve.
And Michael, just lastly, when you look at how globalized we are now, how interconnected we are, and you see companies having to make decisions about pulling out of Russia, how do you think that's going to affect the next round of earnings season?
I'm not an equity person, so I'm not an expert on that particular matter. I will say, with regard to inflation, is a global problem right now. It's everywhere, except maybe in China. But other than that, it's rising and above expected levels everywhere. So the Fed is confronted with a global inflation problem, not just a U.S. inflation problem. So it can't solve the problem all by itself. It can try to ameliorate it, but by and large, it's going to be tough the next couple of quarters, and growth should weaken, not dramatically, not a recession-like weaken, but should continue to slow. Confidence is at low levels, but beware positive surprises. The Fed may decide to have a more protracted, slow hiking cycle, which would be a dovish surprise. It could be that the conflicts in Eastern Europe go away in the next couple of months and things return to a more normal, positive scenario relatively soon.
Beware of surprises indeed. Thank you so much. Thank you to our market panel today, Michael Kushma, CIO of Broad Markets Fixed Income at Morgan Stanley Investment Management, and Jack Ablin, Cresset Capital's Chief Investment Officer. Thank you for your time this afternoon.